Okay, we're all set. Hello, everyone. Welcome. I'm just going to go right ahead. I doubt there's many people who don't know us who are leading it. I'm Carson Brooks, and I'm the broker for a number of Exit Realty offices. Glad to have outside participants, and this is a collaborative effort, once again, between Minneapolis area realtors, our research director, David Arbit, and our stats geek. Oh, there's my dental work coming out. Stats geek Pat. Whoa, that's hard to say when you've had all this. so this is something we've been doing for quite a number of years, and we now do it quarterly, and it is recorded if anyone is interested in that after the fact, including any bad jokes that I might make, which will be topped off by David Arbit. So which of you gentlemen is beginning?
I will begin, but I believe, David, are you going to share my?
David has slides.
Yes, indeed. Let me get that going.
It's working.
Excellent.
Yep. Thank you for everyone's patience, and we are here and thrilled to have you all with us.
Okay. Well, thank you everyone for joining.
I'm going to mute people, and if you have questions, please throw them in the chat. And we'll get to that after. Pat will go first, and David will follow, and then we'll have a short question and answer period at the end.
Thank you, Carson. Appreciate it. Thank you, everyone, for joining us. Sorry about the little bit of a delay in the beginning. Hope you're all staying warm. So let's just move right into it. We're up to a little bit of a late start, but we'll get moving. So David, if you want to go on to the next screen. This is a question we as realtors get asked often. I do anyway. When is the best time to buy? Often I hear this in homebuyer workshops from prospective buyers. And really the answer is always, when you're ready and when you find the right house. But there are oftentimes really wanting to know like what time of year might be the best time to buy, those kinds of questions. And typically, and David, if you want to go to the next slide, please. Typically, in terms of supply-demand ratios, it's usually summertime, early fall, when it tends to favor buyers a little bit more than sellers. Of course, when you get into fall, you're dealing, with a lot of the leftover houses that didn't sell in the spring, So I do like to always shift back to, when you're ready and when you find the right house. Sometimes when I answer the question, if I'm in a sarcastic mood, I might say, well, the best time to buy is 1975, 1995, and 2011. And if you look at this chart here, it's charting out prices going back to 1960. And essentially, those are like points right before the market, boomed and had a significant upturn in prices. But we can't all time it that way. In fact, I do sometimes hear prospective buyers talking these days about waiting for prices to come down before they buy. And if you look at the chart here, that might have worked if you were talking in 2005 or something like that, and then you waited until 2011. But really, that time period, which is in recent memory, where prices did drop significantly, the last time we had significant price drops was really in the 1930s. And so for those that are thinking that way, well, let's just wait for prices to drop. You have to wonder how long are they going to wait, because we had like a roughly a 70-year time period before, between those two significant price drops. So that's it. Let's move on to the next slide. What we're dealing with what we're always dealing with is markets like to be in balance. They're never in perfect balance, and now they're pretty much in significant disbalance or out of balance. So we've got market pressures. Supply and demand are significantly and historically out of balance. There's really a low supply relative to demand. And so that's kind of a pressure, a tension within the market. The release of that pressure, the release of that tension is prices go up. And then essentially what should happen theoretically is as prices go up and housing becomes less affordable, buyers start to drop out of the marketplace And sellers looking at rising prices and feeling, oh, this is wonderful. Maybe sellers then start to jump into the marketplace, and then you get more of a balance and a release from that pressure. So anyway, let's move to the next slide and look at some of the stuff. This one that David shared with me previously, I like this quite a bit. This shows the supply demand measured in months on the left, and it's kind of in inverted order. So the sellers markets typically are thought of as below 6 months of inventory. So 6 months of inventory means the number of houses on the market will take 6 months to sell if nothing new comes on the market. And generally speaking, under 6 months is considered a seller's market. Over 6 months is considered a buyer's market. Now, in the middle on the left side are when prices have dropped. And these are national stats here. On the right side of the middle is when prices have gone up. Okay. And one thing that's very significant, and as I've heard David talk about this before, the upper left quadrant, which is where we've had seller markets where there's been less than 6 months of inventory. There's never been a price drop. This is national numbers, never been a price drop. So the price drops below are always when there's a lot of inventory on the market. And when there's not so much inventory on the market, you're usually going to see price increases. Another thing to point out here is nationally, we've rarely ever seen a time period where there's been less than 2 months of inventory. So we'll keep mental note of that as we go on to the next slide. So this is our month supply here in the Twin Cities. And if you look way over on the right, the actual inventory is less than 2 months. In fact, it's less than 1 month. It's 0.8 of a month. So we're looking at actually quite a bit lower supply and supply demand ratios than the national market, the national market as a whole. In fact, this is kind of a historic chart going back 15 years. So it shows you back when the supply demand ratio was high and prices were falling on the left side of this chart. And the entire right half of the chart, after about 2012, we've got low supply demand ratios and rising prices. Okay. And it's been steadily in that state of a seller's market. And then the last year and a half or so, it's really dropped off into an extreme seller's market. So next slide, please. The previous slide showing the supply demand ratios is kind of the results of what we see here. So this is a historic going back to 1967 of seller activity and buyer activity. So seller activity on the top in blue, buyer activity in red on the bottom. And in the current situation, way over on the right side, you can see that most everything that's coming on the market is actually selling. Okay, so it's a tight market. This is the kind of market that we've had the last 8 years or so, almost 10 years now, that pushes prices up. Okay, not a lot of supply, pretty much all the good stuff is selling. Even this last year, some of the stuff that's not so good is selling because there's just not much on the market. And when those two lines are close together like this, and also back around the turn of the century, so late 90s and early 2000s, you see a lot of upward price pressure. When those two metrics are far apart, like 2007 to 2012, that's where you see falling prices, essentially. One thing that is quite interesting, if you look at those arrows and greens and reds and so forth that kind of track the seller demand, okay, we have had in the last 20, 30 years where we've seen the listing seller demand go in these trends of upward trends, and then it immediately shifts to a downward trend, and then an upward and downward. And then finally, lately, it's kind of gone off track where it's just going sideways. Okay. So essentially, but the sideways that it's going on is at a low point. So this can almost be thought of as an extension of that last red. It dropped down to a low point, and now it's just kind of stayed at a low point. But the interesting thing that I've looked at and noticed is we've looked at the cycles that we've gone through. The booms in the 90s and early 2000s, and then the market crash that then bottomed out in 2012, and then the boom that's been occurring since then and is still happening. So the first forewarning of those market shifts has been seller activity. And you can see the points where it stops going up and then starts coming down, and then it bottoms out and then goes up and then tops out and then comes down and so forth. Those changes have always occurred about 5 or 6 years before you see the really noticeable market change in direction at prices. So in other words, the sellers are the kind of the first ones that change their trending activities. And then after that's been going on for about 5 or 6 years, the whole market shifts. Okay. Now, what's different now, of course, is it's just going sideways. So theoretically, if we follow that kind of pattern, we would need to see seller activity start to go up and then continue to go up for 5 or 6 years before we see a significant change in the price trends. Now, that's not necessarily the way it's going to play out. That's just the way it's played out for the last few cycle changes. Another entirely different option is that the buyer activity drops off somewhat. So some combination of increased seller activity and decreased buyer activity is what it will take to really kind of shift the market out of this extreme sellers market and where price increases start to tame off and drop down significantly. So enough on that slide. Let's move on to the next one. Okay, this slide shows the ratio from the previous slide. So if you take the ratio of sales to new listings, this kind of tracks that. And we're currently at a really high ratio. We're at the highest of all time, 87+%. Prior to this year and last year, we had only reached above 80% 3 times in history. So twice around 1999 and 2000, and then one other time in around 2017-ish or 18, I forget, right about there. And the last 2 years, we've kind of blasted through those old records. And so that's the state of the market that we're in. It's really a historic market of very low supply demand ratios and very high sales to listing ratios. Okay, next slide, please. Okay, so let's look at what's been happening this last year. So we got a few slides here. So next slide. A lot of records, but this wasn't one of them. This is new listings. It's just been kind of the same pattern, just kind of going sideways, but pretty much at low levels of seller activity. Okay, next slide. This shows buyer activity. And we were already close to record highs a few years ago. The previous record was actually 61,000 something. And then last year, we kind of blasted through that record at 64.5. And this year, we're significantly above that. And by the way, these numbers are preliminary numbers. David and Mara and Spar will be revealing the official numbers next week. Okay, these are preliminary, but very close. Okay, next slide, please. And this is what's so significant. 2 years ago, the inventory of homes for sale, 8,300 some, was probably a record low at the time. And then just look how much it's dropped, 30% from there last year, and then another 24% down this year. This really right here shows us and tells us that this coming year, this coming spring market, spring summer market is going to be an awful lot like last year. There's just not much supply. As it comes on the market, the buyers are going to be jumping all over stuff. So next slide, please. Okay, and this shows that in month supply, kind of converts the inventory to month supply. And again, we're for the first time ever below 1%. Okay, at least at the year end December reading. Okay, next slide, please. And this shows the prices. So up 11% over last year. And that is simply what happens when there's such a tight market. Interestingly, some of the national markets, other markets around the nation went up 15, 20%. So this is maybe a little bit of a relief. As tight as the market's been, we didn't go up more than this. Okay. When we were tracking this mid-year, we were up about 15% or so, but by the end of the year, it had kind of calmed down a little bit to this rate. So next slide, please. So this shows the actual dollar volume. And when we have the highest prices ever and the most sales ever, of course, we're going to have the highest dollar volume of sales. And for the first time ever, we're over 25 billion. So there's a lot of activity going on. There's a lot of real estate trading hands in the Twin Cities. Okay, next slide, please. This shows the number of homes for sale. We already did, but this shows it historically going back to 2005. It also kind of gives you a picture of the seasonality of the market. And as I mentioned before, from a seasonal perspective, it's in the summer, the late summer, fall, when there's the most available homes for buyers to look at. So next slide, please. And this one looks very similar, and it kind of converts the last one into the month supply. And you can see again, we've already looked at this slide. It was already low for a number of years, and then it's dropped down to its lowest point yet. Okay, so the next slide will actually show the last 5 years of the previous slide. And you can see just in the last 2 years how it's dropped off. Again, it was already really low, and then it dropped off quite a bit last year and quite a bit more this year. The other interesting thing as we look at this, a closer look at this, is each year in the winter, it kind of hits bottom and then bounces up right away. Not last year. Last year kind of lagged on the bottom, even the last 2 years, but mostly last year kind of lagged on the bottom there. And this is something we're going to be watching in the next few months coming up here to see, if it lags on the bottom like that, and chances are pretty good it probably will. Okay, next slide, please. Okay, this one shows the ratio of sale price to list price. And, we've hit 100% a number of times on median in the past. During this seller's market, every year we hit that. Last year, we busted through and above 100%. And that's just because there were, in the vast majority of situations, multiple offers and buyers paying above list price. So we went up quite handily, almost to 104%.
That's a good reason why the term appraisal gap was not in our language until last year.
Exactly. Thank you. Yeah, and we can expect the same this year. Okay, so next slide, please. This shows days in the market. And again, it's been progressively coming down. This is also very seasonal. And you can see that this last year, there were a few months where it hit just 7 days on the market. Okay, incredibly low market times for median days on market. Okay, next slide, please. And this one's just kind of throw this in here to show you how the demand, is so high and the supply demand ratio is so low, in particular for single family homes and townhomes. Okay, so right about when the pandemic hit, they just took a sharp decline in supply because there was so much demand. Everyone wanted a house or a townhouse, and condos became less popular. Okay, so many of them downtown, for example, and with everything closed downtown, they were a little bit less appealing. So that supply demand ratio went up. It is still in seller's market range. It's still, 2.6 months for condos. But it's not nearly, they're not nearly in as much demand as single family and townhome. So next slide, please. Okay, now let's look at housing affordability a little bit, because this is the other pressure. So we got the one pressure with the low supply demand ratio pushing prices up. The other pressure is that affordability is disappearing. So a lot of people can't afford homes. A large share of our community can't afford homes, unfortunately. So let's go to the next slide, please. And this shows the housing affordability index. And this indicates when it's at 100, that means the median income household can afford the median priced home. And on this chart, we've never actually been that low. So we've kind of floated in the blue to the right, in the blue in recent years, a little under 150. And 150 means the median income household can buy 1.5 houses. Okay. In yellow are kind of projected. So the first one at 128, that's really kind of how we ended the year at about 340,000 roughly. And the interest rate's a little bit below 3.5. But that's what it would drop to at 3.5. So that'd be, 128. The next one all the way over to the right would be if prices go up to 360, which is pretty much a lock for this coming year. And it's probably going to be closer to 375 for this coming year. But and if rates go up to 4%, then we drop down to 117, and we're getting kind of close to the previous lows when the market kind of peaked before the crash in 2006, where it was 111. Okay. There are other significant differences though. Back at that time, we had really high supply. We also had a lot of toxicity in the market with bad subprime mortgages, and a lot of the purchasers back there were purchasing on speculation. So very different times. Okay, so next slide, please. This is a national housing affordability index, and it's kind of inverted from the last one. This one, where it's at a lower point, that means it's more affordable. And actually, because of the really low interest rates and increases in incomes, way over on the right, which is the current time, it's still actually pretty affordable. Okay. It was not so affordable back in 2006. And it was really unaffordable back in the early 80s when interest rates were so high. 16, 17% interest leads to very low affordability. Okay, so next slide, please. Thank you, David. This shows the challenge, though, for lower income buyers. This is Hennepin County, the largest county in the state, with 1 million people. In blue are the number of homes for sale at under 200,000, not condos or townhomes, but single family homes. There are 43. Okay. In red, in all of Hennepin County, this shows homes from 200 to 280. Okay. So in blue, you're looking at people with incomes of 45 to 50,000, roughly, unless they can get some special financing, with gap funding or something like that. In red, you're looking at your buyers with incomes from 65 to 70,000, roughly. And so people in these price ranges, it's very, very tough, and it's very competitive. A lot of demand for these few houses. So this is one of our biggest challenges in our community. Okay, next slide, please. Okay, so we'll just look at a few national trends of importance. So next slide. This is the challenge that we've had in our community and really across the United States, and it goes back even before 2010. It goes back to the previous crash at about 2007. We've just not been building enough homes. So in blue is the construction of new units, whether it's for sale or for rent. In green is how many we actually needed. Okay, so we've been shorting ourselves to the tune of, for the last decade, 6.8 million roughly is the estimate. So we built about 6.8 million less than what we needed. And this is how we get into a situation like we're in. So next slide, please. This shows just builder confidence. And it had the huge drop off at the beginning of the pandemic. But then when the market kind of exploded afterwards, the builder confidence exploded. So ever since then, it's been at highest levels in history. It's not quite as high as it was late last year, but these are some of the highest levels in history of builder confidence. So the challenge is it's getting so expensive to build. Labor and materials, lumber costs are so high.
This is a hot topic of our chief economist, Lawrence Yoon. He talks about this a lot, Pat.
Exactly.
It is a huge issue.
Next slide. Thank you. This shows owner equity, and in green with rising prices, yet mortgage balances not actually going up so much in blue. We have record levels of equity. So this kind of shows us that there's a lot of health. It's a healthy market. The homeowners are in a state of high equity and good health, as compared to during the market crash when values came down and there were a lot of people that were underwater. So next slide, please. Okay. Now these ones are kind of interesting And these ones kind of make it look like we may be approaching historic peaks and price ceilings potentially. This shows us that real house prices adjusted for inflation are actually now up to the highest level ever. Okay. And then if we could go to the next slide shows us the price to rent. And with the huge increases in prices the last couple of years, this is also approaching highs. Now, I do want to forewarn you, this slide is a little bit misleading in that it is capturing the current sale price increases, but it is using a measure for rent that lags behind a year or two. Rents actually went up quite a bit last year by some other measures, but those increases are not reflected on this report because this is using a owner's equivalent of rent that's in the inflation calculations that lags quite a bit. So that's not showing up here. And so the reality is, the current time is probably not nearly as high as is indicated here. The other reality is that inflation numbers we hear in the news from the media that are reported from the government are also using the housing cost component of the inflation is also using the same measure that's lagging behind. So inflation is actually probably considerably higher than what we're hearing. Okay, so next slide, please. And this kind of shows, this is last year, so fairly current, but prices are even higher yet. But this shows where it's more affordable to buy versus rent. In most of our community, it's still actually more affordable to buy than it is to rent. So next slide, please. And these are mortgage rates nationwide. I know most of us can get mortgage rates lower than this still, but we are seeing an increase in mortgage rates. I do want to point out in 2018, when rates went up to almost 5%, that is what it took to get the market to kind of slow down a little bit, where the supply-demand ratio, which had been going down for years pretty much, started to bump up a little bit. Okay, so this is really maybe the fastest way to slow the market down would be significant interest rate increases. And in my opinion, they don't have to go up to 5% like they did then, because they went down so low recently, below 3. I think if they go up to 4 and certainly somewhere between 4 and 4.5, we're going to see some kind of a significant slowdown. But it's not the kind of event that flips the market where we see prices start to come down. Not that kind of event, just kind of a slowdown from an extreme seller's market into more of a normal seller's market. Okay, so next slide, please. So what to expect? And I'm going to finish off with a few slides here and some thoughts, and then David will get into his presentation. So next slide, please. These are some of the underlying market conditions. So we got low supply demand ratio. We still have capacity for price growth, although we may be pushing towards some ceilings there, some potential ceilings. We do have a really high level of owner equity. We've got low interest rates. However, if those rates bump up considerably, then that capacity for price growth gets less. Okay. We have extremely strong buyer demand. And please keep in mind that record sales this last year, but as every realtor knows, there's so many people that didn't buy, okay, that wanted to buy. So when you have 30, 40 offers on some listings, there's a lot of people that didn't buy, and they may have gotten exhausted. They may have dropped out of the market, but there's a lot of pent-up demand there, a lot of strong buyer demand. The potential for increased sellers activity, I don't know how much. I'm not yet seeing any indication of a wave of distressed sellers hitting the market. Foreclosure activity in Minnesota is extremely low still, extremely low. And the process takes, maybe up to 10 months, basically. And in most cases, 6 months after the sheriff's sale. There are some cases where it's 5 weeks, but in most cases, 6 months. And the sheriff's sale numbers are still way low historically. And then, of course, changing housing needs with changing work environments and virtual meetings and so forth, housing needs change. So next slide, please. Concerns. So obviously affordable housing is disappearing. Inequality is growing, okay? When you have so many people that can't even approach to afford the housing that's on the market now for sale, yet it's selling at record rates. So there's a lot of people with significant income that are able to buy, and there's a whole lot of people with really low income. So there's significant inequality. Other concerns: buyer waiving inspections. Buyers waiving inspections. We have buyers overpaying for less than ideal homes. I would certainly expect this year to see, with buyers waiving inspections and paying huge prices last year, some regret and some people finding this home really isn't what they wanted to buy. And they paid so much last year that they're not going to be able to sell it this year without taking a loss. So we probably hear, even though prices are going up this year, we're going to hear stories like that. And then, of course, inflation and potential interest rate increases. And I have no imminent concern of a market crash. Okay, next slide, please. So a little bit of a comparison. People like to compare. They think the prices might be coming down because the market's looking like it was back in 2005 and 6. And yes, it's true, we were at all-time highs with prices rising still. But in 2005, we had a high inventory, a high supply-demand ratio. Affordability was lower than it is now because rates were higher and incomes were lower. Equity was shrinking, and the market was riddled with subprime loans and speculative purchases. So there was toxicity in the market. Now we're at inventory with extreme lows. Equity is still high. Demographics favor more buyers. Okay, the age range of 30 to 40, that population group is high right now, historically high, and growing for the entire rest of the decade. That's the first-time buyer age range, the millennials. Mortgage debt is favorable and very healthy. Okay, low rates, not only low rates, but there's no subprime mortgages out there. It's all people that could definitely afford these mortgages for the long term. Okay, so next slide, please. Thank you. So things to watch for that are going to tell us that the market's changing. The affordability crunch, so rising rates and prices, when is that going to actually impact the market as a whole? We know it's hitting certain people, okay, but the market as a whole still has a lot of demand in it. So when we see that impacting people, so then increase in sellers that are not buying. So are we going to see enough new construction? Are we going to see some wave of distressed sellers? Are there going to be relocations where people are leaving here? And then stories in consumer mood and reduced demand that might spawn from that. So if and when we kind of hit what appears to be a price peak, and if we start reporting price increases that are very low or dropping or whatever, then the word's going to get out there and people will start thinking that, okay, the market's peaking. And if there's media stories about, a lot of people that maybe are losing money on their homes, it could lead to people starting to think, maybe it is a good time to wait, to see what happens. So we got to watch, the stories in the mood that's out there. And then, of course, the ultimate determiner of what's going to happen with prices is that supply-demand ratio. If we see that start to rise, that's what we're watching for. And of course, really the first thing is going to be really a slowdown in the price increases. So instead of going up 11% like this year, maybe it drops back down into the 5% range. So next slide, please. And so long term, certainly we're set up for more price growth in the near term. absolutely 2022, likely 2023. There, nationally and other places, we hear that the market's going to slow down somewhat this year. In the Twin Cities, it sure does not look like that. The possibility, if it does exist, is going to be in the latter half of the year. And then, just like this last year, of course, we always have the seasonal declines in the fall and winter. And as we watched that happen this last year, it was hard to really distinguish between, okay, how much of it is a seasonal decline and or are we actually declining, and starting a trend downwards. And from what I could tell, it was mostly seasonal decline. But we're going to be watching this very carefully and try to look at metrics in different ways to really determine, what the seasonal changes are versus, are there any longer term new trends. I do believe that the coming cycle change, when it happens, will not be extreme like the last cycle change where we had the market crash from 2007 to 2012. Primary difference really is the lack of toxicity in terms of bad mortgages and speculative purchases. And then, of course, the really low supply-demand ratio that we have, combined with demographics that favor more buyers over the rest of this decade. And we're just lagging way behind after years and years of underbuilding. And it's just going to take quite some time to actually catch up with building to meet the needs of increased households. So when the coming cycle changes, I think we're looking at prices, instead of going up really fast, starting to kind of level out and going sideways. Okay, so next slide, please. David, you put this in here. And do you want to take over at this point, David?
Yeah, I think this is me, if you don't mind, and then we'll wrap up kind of together because I've got your wrap up slide at the end. So just a few thoughts for us. Pat, a wonderful job as always. Pat just does a tremendous job from a practitioner standpoint of doing it for decades, of talking about the cycle shift and all the different things. I'm going to talk a little bit just about sort of historical, nuts and bolts of some of the data. I'll talk a little bit about price concessions. We'll touch on luxury. If time permits, we may even touch on urban versus suburban. I know that's been a sexy topic for folks. So as Pat said, here's our minus 1.1%, still preliminary, but is looking pretty accurate and pretty set in stone at this time. So you guys can see 75.5, I guess not quite our lowest. 1, 2, 3, 4. I only count 4 other years since 2003 where we were lower. So 110K, probably a little bit higher. Pat showed us really clearly that sort of supply-driven bubble. And really, that's a trait of most bubbles. It kind of has to be supply-driven, and we just don't see that. If anything, there's a horrific supply shortage. So maybe we don't belong at 110, but we probably belong at closer to 85 or 90. Maybe even 110 would make sense now because demand is up here, right? And population has only grown. So a couple things to kind of think about there. Closed sales, here's our 2.7 that Pat showed, just kind of putting that in context, 66,300. That is the strongest year since at least 03, likely earlier. That's when we can say for sure when our North Star data is sort of valid as of, that's our valid as of date. And so you can kind of see after the crash and the recovery, what was happening in 09, remember that little bit of that tax credit, all right? So policy affects the market. Days on market, 11, Pat showed us this one too. Just want to kind of help us visualize this, a 39, nearly 40% decline. That's a 90% decline from 2011. In 10 years, down 90%, right? From 100 down to about 10. Median sales price, kind of putting this one in context again. There's our roughly 11.25%, 11.5% gain. Would have been nice to hit 340 as a nice round number. Looks like we'll end up at 339.9. That is okay. And you guys can kind of see where we were, peak of the last bubble, kind of riding that wave down and then stomping ever higher. And 11.4, we have to go back to one of those earlier recovery years, right? 2012 was technically that first recovery year. And then we saw some investors and flippers and BlackRock and other institutional folks kind of stepping in and getting a little bite of the pie. And then we saw something happened, obviously last year, that just shoved prices higher. I want to, in addition to prices, Pat touched on this as well. I like to look at year-over-year change in price. So not just price, but year-over-year change. And this really speaks to acceleration versus deceleration. So just one thing to note, everything in blue is above zero. So everything in blue is positive price change, positive price growth. We've been in that place since 2012, right? I think we had 1 month in 2012, looks like maybe Jan and Feb, where prices were still softening. And then we really got into this, what I think of as a first phase of recovery, right? We hit 18% price growth. And then we sort of leveled out. So price growth was positive, but it decelerated, right? And then price growth accelerated, right? And it matches the timeline perfectly with COVID, right? I think we needed a month or two to sort of digest. And by June, right? So April and May were kind of a little bit slower, but by June, boom, June, July, we were 10% plus, reaching 16.5%. However, decelerating back down to 7.5%. It looks like that period of the fast growth is probably a little bit behind us. And it feels like we're settling into, Pat and I have talked about 6 to 8%, 5 to 7, maybe 4 to 6, depending, a more historically average rate of appreciation. Okay, just a word on this urban market share, you guys. What a fascinating one. So look at how December ended. This is the percentage of sales that are happening in either Minneapolis or St. Paul, so kind of urban market share. December had the highest share of sales taking place in the core cities since May of 2015, right? So that's a 6.5 year high. Stories of exodus and fleeing the city. This doesn't seem to support that. That said, right after April, Carson's testifying here. Yeah. After April, we did see a decline, and then people really scooped up those opportunities. So this is not consistent with the narrative of people fleeing cities. It simply isn't. It just simply isn't. Interesting condo market share. Remember our condo bubble, right? All that mostly happening in our 2 core cities. So a little bit of an interesting data point there. All right, I said we'll touch on this, so let's just touch on it. Look at the change in seller activity in Minneapolis in blue versus the suburbs in orange. Golly, did we see an uptick in Minneapolis seller activity, right? 30%. Huh. How about buyer activity on the closed sales side? Look at Minneapolis in blue versus the suburbs in orange. Huh, we have a corresponding 30 or 40% increase in sales. So yes, we saw an increase in seller activity. We also saw a corresponding surge in buyer activity. So there was higher churn or higher turnover, right? Not an exodus, but higher turnover. So just a note there, we did a white paper a couple months ago and that got some pickup. So I wanted to touch on it. As we think about, we've been talking a lot about prices and interest rates. What we haven't talked a ton about is PITI payments, is just monthly payments. We're in a monthly payment business where 90% of people, right, use a mortgage, have a payment. Roughly 10%, 11% use cash, so don't have a payment outside of, I guess, taxes and insurance. So how do these 3 factors sort of talk to each other? How do they behave together? So look at median price here in dark blue, all-time highs, right, above that 05 peak. And then look at mortgage interest rates in kind of light blue, pretty much at all-time lows, really multi-decade. I think it's actually 50-year low plus we hit. But this index shows it's at the lowest level since 1990. But what about monthly payments in between? Look at monthly homeowner costs. Yes, they've risen, but they've actually been flat the last couple of years because interest rates have been so favorable. So prices are above all-time highs, but are payments always above all-time highs? And I think that matters. So just an interesting note there. Let's touch very briefly, time check 52. Let's touch just very briefly on luxury. So December, we showed a 21.33% increase in million plus to 108 units for a December. Even in December of 05, right, we were more than double that. December of 05, only 50. But this 21% came after a 65% surge and luxury market activity. December year to date. So for this year, it's looking like about a 50%, right? So we just looked at December. Now, how about this whole year, this whole 2021 year to date as a whole? And that was about a 50% to 1,400. We are nearly 3 times the luxury market share that we were at in 05, right? 500 to about 1,500. Really an incredible trend. Maybe that surprises some people. By the way, guys, just another note, just based on the charts we just looked at, some of you might be thinking this is all going on Lake Minnetonka, right? Or Lake Harriet or Bede-Makaska, right? You'd be a little bit wrong, because a lot of these $1 million plus purchases are happening right in downtown Minneapolis at 11 Tower, right? A luxury tower. So here are dozens and dozens of high net worth individuals who really have the wherewithal to buy a second home wherever, right? Maybe a third home wherever. They're choosing to make an investment in the city. And I think that does speak volumes. Okay, just a word on inflation. There are 2 ways to think about this, and I'm still not convinced of which way is better. So I'll show you guys both. We've got nominal home prices in red. This is simply reported home prices, not adjusted for inflation, just nominal. And then in blue, we've got implied or inflation adjusted or real home prices. And we're framing those in $2,003. So both start at the same time, because $2,003 and 2003, same thing. Look at actual nominal home prices, right? Stretching up to 350, 349-ish, right? But look at real prices. Sure, they're above their peak, right? They're above peak bubble levels, but not by that much, right? Suggesting perhaps there's still some room to run in a real inflation adjusted sense. All right, the second way to look at this, maybe you guys tell me what you prefer. The second way to look at this, let's now frame it in 2021 dollars. So now we're sort of forecasting that back. Look at what we would have paid for a home back in 05, 06 if we were paying in 2021 dollars. We would have paid about $325. The nominal home price makes it look like we would pay about what, $235. Right. So this is why it is important to kind of frame home prices or present them in inflation adjusted terms. So this gap here is caused by inflation. In the other one, this gap here is caused by inflation. So it's just where the gap kind of shows up in present day, or sort of back when, what we would have paid in today's dollar. So just a couple ways to think about it. Okay, cash sales. I said 90%, looks like 87.5% use a mortgage, because about 12% pay in cash. So this is an interesting one. Pre-crash 03, 04, I guess through 07, let's call it 4 to 6%, right? About 4.5 to 6%, of our market was purchased in cash. And then, after the crash, this was some investor dollars, right? 23%, some investors and flippers. And that's kind of gone down as, the market has continued to appreciate, maybe less opportunity for returns there. We did see a little bit of an increase. Maybe you guys have theories, but I just think it's so interesting to think about, did something change when interest rates went way low after the Great Recession, where investors felt the need to chase yields in residential real estate because CDs and bonds and money markets weren't paying them anything? So invest in a really safe asset class, and residential real estate, let's buy a REIT.
Yeah, let me just add a note here. I'm sure many of you have seen news media talk about these big investors coming in and purchasing all the single family homes and so forth. And that does exist. But you all know that the large investors do pay cash for the most part. And I think the media is really scrutinizing this now because there's such a low inventory. And so everyone's kind of looking at, okay, what's the problem? There's not enough homes for sale, and these investors are scooping them up. But there was more of this activity earlier, as this chart indicates.
Yep, it's a good point. And I think the Federal Reserve released a tool actually just this morning, and I was on the sort of task force guiding it a little bit, advisory group. And yeah, just like Pat said, I think Eric and I showed that it went from 2% to 4.3 or 4.1 or something, but that's over 15 years. So it's not a huge change. And even 4% isn't a huge share. That said, in parts of North and Northeast Minneapolis, it is as high as 20, 30%. So, there's obviously pockets of hot spots and cold spots, but overall, there's no way we can call this a crisis, right? And like Pat said, it's felt more in this low inventory environment. So just an interesting thought there. Well, let's just do this real quick. Some of you have heard the Zillow news, right? So what's happening with 8045 Bush Lake Road here, original list. Kind of interesting here. Look at the change, right? 475 to 469 to 459 to 49 to 24 to 19 to 14. Fine, we'll put it at 399, and then might it sell? Well, I don't know. That was about a month and a half ago. So interesting news with Zillow. I want to also talk about price reduction. So let me just spend a minute on this briefly. So this is annually, this is the percentage of closings that required a price reduction. So that sold at an amount lower than that original list price. Market was pretty strong, right? Only 30%. Market sort of unraveled. Now 50% of our deals required some form of price concession or price reduction between 2008 and 2012. Market healed, got a lot stronger, got a lot hotter. So last year overall, only about 1 in 5, right? 20% of listings required a price reduction before going under contract or off market. How about just August? Okay, so August, I'm still showing this decline down to 17%. How about for October? For October, we actually did register a little bit of an uptick in price concessions and price reductions. Let's fast forward November as well. We did show just a hair of an uptick in price reductions. I'm not sure whether this is the beginning of a new trend, whether we've kicked, whether this trend is going to, suddenly become that trend. We can't say that for sure, but it's something that we're watching, and we have seen a little bit of movement, of kind of opposite movement. December as well, you guys, a little bit of an uptick. So October, little uptrend, November, little uptrend, December, little uptrend. I guess if we have a fourth, maybe we can start to call that patternistic. We used to joke 10 years ago, Pat and Aaron and Jeff and I used to use our Yoda voice. 1 month does not a trend make, young Skywalker. Anyway, so another way to think about this, guys, is just actually looking at month-to-month change, right? Going all the way back to January of 2019 and every month into last month, right? So you can see a lot of price concessions in January's and December's, not a ton when the market's hot, spring, summer market. I don't need to make concessions. Right? Okay. So usually 2019 is a U shape. 2021 was also a U shape. 2021 was a W shape, right? Never have I really seen price reductions decline heading into September, right? Look at September of 19. We had 1, 2, 3, 4 gains. Look at September of 21. We had 1, 2, 3, 4 gains. September of 2020, we were declining into it. So really just speaks to how summer market was shoved into fall, delayed, postponed. Last one, I think average equity gained over the last 12 months. Pat mentioned, Pat reinforced that notion. There's trillions in equity and new equity. Homeowners are sitting pretty. They're really sitting pretty well in terms of equity and outstanding balance. Here, typical homeowner gained about 33K over the last year. Our friends in California and Washington, a little over 100K. I'm a little bit upset that Indiana beat us kind of in this Midwest neighborhood here.
Oh, wow.
Yeah, a little bit of a surprise to me.
Yes.
I'm also a little bit surprised. Sometimes West Virginia has beat us out in terms of home ownership rate. I don't know. Coal miners get paid pretty well, but homes are still pretty cheap.
Yeah.
Best I can do. I want to turn it back over to Pat for some of his closing remarks.
Well, and we have a few questions that we can try to fit in.
Yes.
Right. I just kind of made note of some of the questions. I glanced through. A lot of the questions in chat were actually being answered.
Yes.
But I just wanted to address a couple of them. I know Kim asked about rising wages and declining unemployment and factoring into those things. And those absolutely factor into the housing affordability indexes that we look at. And that's a big part of what is making it appear as though housing is still affordable. But I think, as I talked before about inequality, there's significant rising wages. You hear people talk about who's buying all these houses, and you got, these major investors, and you've got Zillow and others, but really, honestly, there's a lot of homegrown people where, could be a single person or it could be a couple that have jobs in the IT industry or nurses or whatever, and their incomes are 1 to 200 to 300,000 or so, and they could afford 7 to 800,000, and they're buying these median priced homes at 350, and there's thousands of these households. And with the growing millennial population between 30 to 40 in age, many of them are high earners and able to buy. So that's part of the market. I know Bill asked about rent control. Denise asked about TOPA. And in terms of these things affecting prices, there's probably not too much of that, because these are a smaller share of the market that's rental properties, and the majority of the market is still single family homes. But these are definitely factors that can, and we're already seeing in St. Paul, discourage development and discourage investment, and make all kinds of problems that we are fighting these policies at every level, local, state, and federal government, with our advocacy. Bill Pankinen asked about baby boomers, and I think Carson answered a lot of people. This is my age group. We're staying in place, and where maybe we should be selling, or at least that's the, historical pattern. A lot of us are not selling. And so that's part of the challenge. And many of us are buying, actually. So we're part of the buyers. So Tom asked about the foreclosure rate, and everything that I can see so far is the foreclosure rate's very, very low still. We know there were moratoriums and there were forbearances, and it dropped way, way down. And the moratoriums are over, but the foreclosure rate has not increased yet. So I almost hope to see it go up a little bit so we can get some more sellers in the market.
Yeah.
But, that's kind of a mixed thing. So basically, I don't know if there's other questions.
Pat, Kim just added another question.
Okay.
What opportunities exist for homeowners with abundant equity?
Well, there's still not much on the market. Okay. But that is obviously, a comfortable position to be in. In terms of, and Kim, of course, you're a mortgage broker, so more about, what it takes to buy something and what it takes to buy something first before you sell, which is really advantageous in this market. But the many, many homeowners with abundant equity, and I've talked about this a few times, and David mentioned, that's a really beneficial thing in our entire market environment. And I don't know if Kim, if you have anything more to add in terms of, the financing methods that can be used to purchase first or whatever, taking advantage of the equity, or even buying a second home or an investment property. But those are significant advantages.
Well, Pat, and as always, you've nailed it. And the one thing that I hear all over town, right, is a lot of sellers are reluctant to list for fear of not being able to find their next home, what it is that they want to move into. And so with that dynamic in place, in most situations, you're never going to have to execute on this, but having a bridge loan as a arrow in your quiver, so to speak, right, gives you the ability to make that non-contingent offer that will have your offers considered over people making contingent offers. And as everyone's
that
aware,
is a really good tool. I just helped somebody with that, and they were shocked that they could create some financing leverage so they can make a purchase independent of their selling. It helps us too with having a property to sell.
Super.
Yeah.
Thank you.
Thank you, Kim. Thank you, David. Arbit had to leave a little bit early.
Preparing for the next presentation on this with our incoming president, Denise Maison. So that's very cool.
Yeah, and thank you, Denise Mazzone, for joining us, president of the Minneapolis Area of Realtors. And thank you, everyone, for joining us. I don't know if there's any other questions at this point, but we greatly appreciate this.
We appreciate